The US stock market is sending mixed signals right now. Prices keep climbing, but something feels off. On November 4th, the S&P 500 dropped 1.17% and the Nasdaq fell 2.04%. AI-related stocks took the hardest hit, with Palantir cratering nearly 8%. Here's the strange part: Palantir's earnings were spectacular. Q3 revenue beat market expectations, and crucially, U.S. commercial revenue surged 121% year-over-year. This company, once dependent on government contracts, is now exploding in the private sector. So why did it crash? Michael Burry, the Big Short investor famous for his 2008 subprime mortgage bet, revealed he's holding $912 million in Palantir put options. When the guy who predicted the financial crisis bets against you, people get nervous. Major bank CEOs piled on. At a Hong Kong financial summit, Capital Group's CEO said, "Earnings are strong, but valuation is the problem." Morgan Stanley and Goldman Sachs CEOs echoed similar concerns, noting that corrections are a normal part of market cycles. The market's anxiety is palpable. The reality is that the US market has become concentrated. The M9, the top 9 companies by market cap: Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, Tesla, Broadcom, Oracle, now represent over 40% of the S&P 500. This level of concentration mirrors what we saw just before the dot-com bubble burst. The gap between the market cap-weighted S&P 500 and the equal-weighted version has widened dramatically. According to Bank of Korea financial stability reports, when capital flows concentrate into a handful of stocks, correction risk increases significantly. But here's where it gets interesting. The percentage of S&P 500 stocks trading above their 20-day, 50-day, 100-day, and 200-day moving averages keeps declining. The index rises, but fewer stocks participate. A handful of megacaps are carrying the entire market. However, you can't judge value by price alone. Bloomberg data shows M9 companies have a 12-month forward EPS growth rate of 19.2%. The remaining 494 companies S&P 491 show just 9.7%, nearly half the rate. Even more striking, on a 24-month basis, M9 companies project 40.5% growth versus 20.8% for the S&P 491. So even if M9 stocks look expensive, they're actually growing fast enough to justify their valuations. There's a metric called the PEG ratio, price to earnings divided by EPS growth rate. It measures whether valuation is reasonable relative to growth. M9 companies have a PEG ratio of 1.61x, while S&P 491 sits at 1.97x. M9 is actually cheaper on a growth-adjusted basis. Growth stocks get criticized for being overvalued, but when you factor in growth rates, the story changes. Of course, this assumes market forecasts are accurate. The 12-month forward EPS represents what analysts expect companies to earn over the next year. These projections can be wrong. Concerns about AI hype or economic slowdown always linger. But if the current correction stems from psychological factors, prices rose too fast, rather than fundamental deterioration, the narrative shifts. Let's revisit Palantir. Q3 revenue jumped 63% year-over-year, with U.S. commercial up 121%. Total contract value (TCV) increased 151%, with U.S. commercial TCV skyrocketing 342%. This demonstrates explosive private sector adoption beyond government dependence. Yet the stock dropped 8%. Because of Burry's put options. AMD tells a similar story. The company posted record quarterly revenue and guided Q4 revenue to $9.6 billion, up 24% year-over-year. Yet shares fell over 3% in after-hours trading. This despite announcing a 6 GW GPU supply deal with OpenAI. When strong earnings trigger sell-offs, it means expectations were even higher. The market is essentially saying, "We already priced this in." Growth stocks particularly tend to front-run future earnings, So even good results can disappoint if they don't exceed sky-high expectations. So is this a dangerous moment or an opportunity? According to Financial Supervisory Service reports, Federal Reserve policy is the key variable. When rates rise, deposit yields increase, money flows out of stocks, growth stocks dependent on future earnings get hit hardest. When the Fed raised rates by 0.25% in March this year, the Kospi dropped over 5% in 2 weeks. But the Fed has paused its rate hiking cycle. There's widespread speculation about potential rate cuts next year. That would create a favorable environment for growth stocks. Quick note on Tesla. China Passenger Car Association (CPCA) data shows Tesla's China-produced EV sales fell 9.9% year-over-year in October. After a brief September increase, growth turned negative again. Competition in China's EV market is brutal, with local players like BYD flooding the market with competitive models. Adding to Tesla's woes, Norway's sovereign wealth fund announced opposition to Elon Musk's CEO compensation package ahead of Thursday's shareholder meeting, citing excessive compensation and dilution concerns. These governance risks weighed on the stock. Conversely, Apple rose 0.4% on news of entering the budget laptop market. Despite broader growth stock weakness, Apple held up. The company reportedly aims to compete with Google Chromebooks and budget Windows PCs, a strategic shift from its premium-only focus to expand total addressable market TAM. The margin concern is real, though. Apple built its business on high-margin premium products. Moving downmarket could compress profitability. Here's the bottom line. The current market turmoil stems not from fundamental deterioration, but from psychological concerns that prices rose too fast. M9 companies' actual growth rates justify their premiums, and their PEG ratios suggest they're undervalued relative to the broader market. Sure, growth forecasts could be wrong, but considering Palantir's explosive commercial growth, AMD's OpenAI partnership, and the Fed's pause on rate hikes, near-term corrections seem likely, but the medium-term trend should persist. Burry's put options represent a warning, not a conviction. The 2008 subprime crisis involved a structurally doomed system. Today's situation is fundamentally different. This might simply be a hedge against short-term overheating. Ultimately, we need to focus on actual company growth, not just price movements. Technical indicators like 20-day, 50-day, 100-day, and 200-day moving averages matter for short-term signals. But long-term, what drives stock prices are fundamentals: EPS growth, new contracts, market share gains. Don't panic and sell everything because of a correction. For companies with solid fundamentals, these pullbacks can create opportunities.